Hi everyone, I'm Rhys Adams. I'm the CEO of Eaton Square and I'm here with Stefan Shaffer. Stefan, your firm focuses on finding debt and equity for firms across the US, Canada and Asia Pacific. How are you seeing the market at the moment?
Maurice, thanks for having me. I think it goes without saying that everything has been dramatically impacted by the influence of COVID-19. The market is not shut down, however. The market is still liquid. It's really just somewhat reticent to set rates and terms right now. So deal that would normally get done in 8 to 10 weeks is probably going to be closer to a 12 to maybe even a 15-week execution time. And again, it's simply that people are nervous at this point about setting specific terms when they're not really sure when this is going to shake out. But they are reviewing deals and they are interested in seeing new deals, and deals are still being processed.
Okay, so that's good to hear. So things are quite different than the GFC that other people have lived
I think in the GFC, there was such a fundamental concern with liquidity in the system itself. The banks had all these toxic assets. There were so many things that threatened the financial system itself. This is a secular event, the COVID-19. It's influencing the general economy, but the liquidity is still in the system, and it has been in the system. And financial institutions like the commercial banks are significantly healthier today than they were back in 2007, 2008.
Oh, that's good to hear. So how are you seeing this situation impact debt structures and the deals that can be done at the moment?
Again, as you can appreciate, whenever there's a dislocation in the market, there's going to be a little bit more caution. And when it comes to capital markets, caution translates to higher spreads and less leverage tolerances. So we've seen spreads with the commercial banks going up about 50 to 100 basis points, again, reflecting the somewhat just concern about where the market is and where it'll settle. And with the non-banking market, which is a little bit more volatile, and where buyers also invest in both the public markets and the private markets, and accordingly they look for relative value, we've seen spreads go up there probably 1 to 2%. Leverage tolerances have also been reduced about a turn right now. Again, it's somewhat temporary, and it's what we see all the time when there's dislocation or dysfunction in the market.
Okay, fantastic. And finally, how do you think, excuse me, how do you think lenders are going to deal with normalized EBITDA going forward?
Well, I think that's a good point. I mean, EBITDA for every company, when you've shut down an economy, is going to be missing 2 months of performance, and it'll be slow to ramp up. So this concept of normalized EBITDA, what would the company look like if it was still running, through this period, is going to be the new concept of EBITDA. We have, you've seen real EBITDA. We have adjusted EBITDA, where we add back certain things. And now this new concept of normalized EBITDA, where we basically will annualize operations pre-COVID and post-COVID.
Yeah, okay, fantastic. Well, thanks, Stefan. Thanks for giving us your time today. And so my takeaways from there are that is still available. Getting a commitment from lenders at the moment is a little bit more challenging, and therefore timelines are a little bit extended, but certainly there's work there to be done. So thanks again. See you again.
Thank you very much.